Hello, my name is Ora Bailey, and I am going to help you understand some of these basic principles of financial accounting based on the test questions of your school. Hi, and welcome to this session on financial accounting. Today, we are going to talk about something really important, the auditor's report. This report tells us if a company's financial statements give a fair picture of its financial position and results. When you look at a company's annual report, there are a lot of sections that provide different information. But if you want to know whether the financial statements are accurate and fair, you need to look at the auditor's report. The auditor's report is usually located towards the end of the financial section of an annual report. It is written by an independent auditor who reviews the company's financial records. The auditor will tell you whether the financial statements have been prepared correctly according to the standards. For example, in this sample report here, you'll see the auditor's opinion right here. It states that the financial statements give a fair depiction of the company's financial status. This is critical for investors, lenders, and even the company's management because it provides assurance that the numbers on the balance sheet and income statement can be trusted. So, next time you read an annual report, don't skip over the auditor's section. It holds the key to verifying the accuracy of the financial statement. Okay, let's go over and start on lesson 2. We are going to talk about one of the foundational assumptions in accounting, the going concern assumption. When accountants prepare financial statements, they assume that the business will continue operating for the foreseeable future. This is called the going concern assumption. It's an important concept because it affects how we record and present financial data. For instance, if a company is assumed to continue operating, we spread out the costs of assets over several years, like machinery or buildings. But what happens if the company is in trouble, like facing bankruptcy? Well, the going concern assumption would be questioned, and we'd have to present the financial data differently, maybe by listing assets at liquidation value. Here's an example of a company that was facing bankruptcy. Because there were doubts about its ability to continue operating, the accountant had to reassess the financial statements. So, remember, this assumption is built into most financial reporting, but it's not always set in stone. It depends on the company's future outlook. We are diving into a really essential concept, net income. Now, net income is what's left over after a business subtracts its expenses from its revenues. It tells us how much profit a company made during a certain period. The formula is pretty simple. Net income equals revenues minus expenses. But there's also something else to think about, dividends. Dividends are payments made to the business owners or shareholders. We subtract them from net income when calculating what's left for the business. Let's look at an example using Johnny's car repair shop. Johnny started the year with $100,000 in car repair revenues and $55,000 in expenses. If we subtract the expenses from the revenues, we get a net income of $45,000. Easy, right? But then Johnny paid out $10,000 in dividends. So, what is left after that? The answer is $35,000. This is the true net income after paying dividends. Remember, net income gives us a clear picture of how much money a company is actually making after covering all its expenses. We are going to talk about a special section in the statement of cash flows, non-cash investing and financing activities. When a company makes significant purchases, like buying an office building, it doesn't always pay cash upfront. Sometimes it issues a long-term note instead. This is called a non-cash transaction because, well, no cash is involved. These types of transactions will need to be reported because they affect the company's financial position. However, instead of appearing under the operating, investing, or financing sections, non-cash activities are listed separately in the statement of cash flows. For example, let's say a company buys an office building by issuing a long-term note payable. There's no cash outflow, but this purchase still impacts the company's liabilities and assets. So we report it as a non-cash investing and financing activity. This might sound tricky at first, but with practice, you'll get the hang of it. The key is to remember that just because no cash is involved doesn't mean it's not important. Analyzing net income based on beginning and ending capital. Hello again, everyone. In this lesson, we're going to explore how to calculate net income or net loss using the beginning and ending capital balances. When a business starts the year, it has a certain amount of capital. By the end of the year, the capital has changed based on how much money the business made or lost. If we know the beginning capital, ending capital, and any withdrawals the owner made, we can figure out the net income. Here's the formula. Net income equals ending capital minus beginning capital plus any withdrawals. Let's try an example. If a business starts the year with 25,000 in capital and ends the year with 37,000, but the owner withdrew 23,000 during the year, we use the formula to find that the net income is 35,000. It's a straightforward way to see the profit or loss based on how the owner's capital changes throughout the year. All right, now let's talk about deferred income tax liabilities. Let's talk about something that can be a bit confusing at first. Deferred income tax liabilities. Sometimes the rules for financial accounting, called GAAP, and the rules for tax accounting don't match up exactly. This creates a temporary difference in how much tax a company owes according to its financial statements versus its tax return. When this happens, the company might defer some of its tax payments to future years. This is called deferred income liability. Deferred income tax liability. This is called a deferred income tax liability. This is called a deferred income tax liability. So let's say it again. Sometimes the rules for financial accounting, called GAAP, and the rules for tax accounting don't match up exactly. This creates a temporary difference in how much tax a company owes according to its financial statements versus its tax return. And when this happens, the company might defer some of its tax payments to future years. This is called a deferred income tax liability. For example, if a company uses different methods for depreciation in its financial statements and tax returns, it might owe less tax now, but more tax in the future. The difference between the two is recorded as a deferred income tax liability. The key thing to remember is that these liabilities are temporary. Eventually, the company will pay the taxes it owes, but for now, it's deferred to a later time. Lower of cost or market inventory valuation. Welcome back. In this lesson, we are going to look at how to value inventory using the lower of cost or market method. Sometimes the value of a company's inventory might drop below what the company paid for it. In these cases, we have to adjust the value of the inventory to the lower of its original cost or its current market value. Let's look at an example. Imagine a company has 200 units of inventory that it bought for $16 each, but the market price has dropped to $15 per unit. According to the lower of cost or market rule, we would value the inventory at the lower amount, in this case, $15 per unit. Now, multiply that by the 200 units, and the value of the inventory becomes $3,000. But if the market value falls even further, let's say to $13 per unit, then we would have to reduce the inventory value to $2,600. This method helps companies avoid overvaluing their assets when market prices drop. Return on assets ratio as a measure of profitability. Hey, today we are going to talk about a key measure of profitability, the return on assets ratio or ROA. This ratio helps you understand how efficiently a company is using its assets to generate profits. The formula is pretty simple. ROA equals net income divided by total assets. For example, if a company has $100,000 in net income and $500,000 in total assets, we divide $100,000 by $500,000 to get an ROA of 20%. This tells us that for every dollar the company has in assets, it's generating 20 cents in profit. A higher ROA means the company is doing a good job of using its assets to make money. It's really useful way to compare how profitable different companies are. Mhm. Working capital and its role in liquidity. Hi, today we are going to talk about working capital, which is a key measure of a company's liquidity or its ability to meet short-term obligations. Hi, today we are going to talk about working capital, which is a key measure of a company's liquidity or its ability to meet short-term obligations. Working capital is calculated by subtracting current liabilities from current assets. It's a simple formula, but it tells us a lot about the financial health of a business. Positive working capital means the company can pay off its short-term debts, while negative working capital can be a sign of trouble. Let's look at an example. If a company has Let's look at an example. Let's look at an example. If a company has 50,000 in current assets and 30,000 in current liabilities, its working capital would be 20,000. This means the company has 20,000 available to cover its short-term debts. Having enough working capital is crucial for keeping the business running smoothly, paying bills, and investing in growth opportunities. Understanding book value of plant assets. Hi, everyone. Today we are going to talk about the book value of plant assets. Book value is what an asset is recorded at on the balance sheet after accounting for depreciation. Here is the formula. Book value equals the original cost of the asset minus the accumulated depreciation. Over time, as assets like machinery or buildings are used, they lose value, and that's what depreciation represents. For example, if a company buys a machine for 50,000 and has accumulated 10,000 in depreciation, the book value of that machine would be 40,000. This number shows up on the company's balance sheet. Remember, book value is different from market value. While market value reflects what the asset could sell for today, book value shows what's left of the original cost after depreciation. It's an important concept for understanding a company's financial position. Depreciation using double declining balance method. Hi again. Today we are going to learn about the double declining balance method for calculating depreciation. This method is what we call an accelerated depreciation method. It means that we're going to depreciate more of the asset's value in the earlier years of its useful life. The formula is depreciation expense equals 2 times the straight line depreciation rate multiplied by the book value. Let's take an example. A company buys a cash register for $5,400 with a useful life of 10 years and a salvage value of $400. In the second year, we calculate the depreciation using this formula and find that the expense is $864. It's a bit more complex than the straight line method, but it helps businesses recognize a higher depreciation expense earlier on, which can be helpful for tax purposes. Don't worry if it seems tricky at first. With practice, it gets easier. Activities in the statement of cash flows. Okay, we are going to talk about the statement of cash flows, especially the different types of activities that show up on it. There are three categories: operating activities, investing activities, and financing activities. Operating activities are relating to the day-to-day operations of the business, like paying suppliers or collecting from customers. Investing activities include buying and selling assets like equipment or land. And financing activities involve transactions with the company's creditors or owners, like issuing stock or paying off loans. Let's look at a few examples. Paying employees would be an operating activity. Purchasing new equipment would be investing, and paying dividends to shareholders would be financing. By understanding the differences between these activities, you can get a clearer picture of where a company's cash is coming from and where it's going. Net present value and investment decisions. Hi, everyone. In this lesson, we are going to discuss net present value, or NPV, which is a critical tool in making investment decisions. NPV, or net present value, helps us decide whether an investment is worthwhile by comparing the present value of cash inflows to the present value of cash outflows. The formula is simple. NPV equals the present value of the cash inflows minus the present value of the cash outflows. If the NPV is positive, that means the investment is expected to generate more cash than it costs, which is a good thing. If it is negative, then the investment may not be worth it, and the costs outweigh the benefits. Let's take an example. Suppose you're considering an investment that will bring in $50,000 over the next 5 years, but the upfront cost is $45,000. By calculating the net present value of those cash inflows and outflows, you find that the NPV is $5,000. Since it's positive, this would be a favorable investment. NPV helps us make better financial decisions by taking into account the time value of money. So it's an essential tool for anyone in business or finance. We are going to talk about deferrals in financial accounting. Deferrals occur when we delay recognizing revenue or expenses until a later period. This usually happens because we've received or paid cash, but haven't yet earned the revenue or incurred the expense. Let's look at a common example: prepaid rent. If a company pays for rent in advance, we wouldn't record the entire amount as an expense immediately. Instead, we would defer that expense and recognize it over time as the rent is used up. Similarly, if a business receives cash from a customer before delivering a service, we record that as unearned revenue, a liability, until the service is actually performed. Deferrals help ensure that revenue and expenses are recognized in the correct periods, matching the financial activity with the appropriate time frame. Understanding deferrals is key to accurate financial accounting. Net income and owner's capital. Hello! In this lesson, we are going to look at how net income or net loss is determined by changes in owner's capital and withdrawals. When a business starts the year, it has a certain amount of owner's capital. By the end of the year, that amount has changed based on how much profit or loss the business made. If we know the beginning capital, ending capital, and any withdrawals the owner made, we can calculate the net income or loss of the year or for the year. If we know the beginning capital, the ending capital, and any withdrawals the owner made, we can calculate the net income or loss for the year. Here is the formula. Net income equals ending capital minus beginning capital plus any withdrawals. For example, if a business starts the year with $50,000 in capital and ends with $75,000, but the owner withdrew $30,000 during the year, we use the formula to calculate the company's net income was $55,000. Understanding this relationship between capital and net income is key to evaluating a company's financial performance over time. Revenue recognition issues. Hi, today we are going to discuss an important issue in accounting: revenue recognition. Revenue recognition is all about deciding when to record revenue. Should we record it when we receive the order or when we actually deliver the service? This is called the recognition issue. For example, let's say that a business receives an order for services today, but won't perform those services until next month. We don't recognize the revenue today. We wait until the service is performed. This way, the revenue is matched to the correct period when the work is done. Recognition issues can be tricky, but the key is to follow the rules of accounting so that revenue is recorded in the right period. This ensures that financial statements are accurate and reflect the true financial health of the business. Okay, this concludes all of the lessons for financial accounting for now. I hope you enjoyed it, and good luck. Let me know if you have any questions in the comments. Bye.